I agree with you that this seller wants their cake and to eat it too. And I think that that's probably a better way to go. I think you'd make about the same amount of money, but it's an easier product to sell on the back end, knowing that it has a little bit of equity into the deal. Welcome back to another episode of Buy This and Not That, where Jamil and I compare two properties that were submitted to us by the BiggerPockets community. Today, we actually have two deals, both creative finance. So it's going to be a special episode. Now, Jamil, Damji, and I are both on Triple Digit Flip on A&E, where we get to look at deals all the time. We get to have conversations when we're on set, when we're driving around, when we're having lunch, we're on the airplane. Today's episode is all about the way we would look at deals and the way we would analyze deals. And hopefully you guys can get some insight into some of the questions we ask each other so that this helps you guys know whether you should buy this or buy that. Jamil, Damji, how you doing today, brother?
I'm fantastic, man. I'm excited to be talking about some creative deals because, I'm sitting with a creative finance master. I don't think there's anybody in America that understands how to really look at properties in creative ways and understanding leverage and understanding how you can really get an asset out of a note. And it's a lot different from the way that I do real estate. I'm a cash buyer. I typically look for deals with tremendous amounts of equity or potential equity that we can force appreciation on. And so looking at deals from a different lens is really interesting for me. And I love learning new things. And so I'd love to get your insights on the deal that was presented to me that has a creative solution.
Let's have you start first. What do you have for us today?
Awesome. Well, I've got a creative deal actually located here in Phoenix, Arizona. So it might be one that you would be interested in purchasing. And this one came from the BiggerPockets community, but this individual happens to be, it's actually two people. It is a sub-2 student and an astro student who met each other at the BP convention. Interesting, right?
No way.
I love the collaboration that happens in situations like that. And so these two teamed up and they've been working on wholesale deals and wholesaling creative deals. And this was one that they brought to me last night. So this specific deal has the following situation. It has a $430,000 loan on it. The interest rate on the loan is 3.25%. It has 26 years left on the note. So it was purchased not too long ago, obviously in a 30-year mortgage, right?
Yeah.
The monthly payment is $1,871 PITI.
Okay.
The rub, in my opinion, is the seller wants $100,000 down.
Okay.
When you look at the renovation expense that could be possibly needed in it, I don't see that there's going to be a ton of renovations required because the pictures that I've seen, the house looked very updated. It's in really beautiful condition. I think it could be a great Airbnb. I think it would be a really nice corporate rental. And at 1871 PITI, my guess is you could probably rent a property in this price point for like $2,300 a month. So there's a significant opportunity to gain monthly cash flow. So, if you had a $500 a month cash surplus on that house, it's a pretty good return. But for $100,000 down, that to me seems like way too high of an entry fee. And I looked at the ARV. So I looked at what the property would be worth top retail in today's market, and it's $500,000. So essentially, they're saying they think the property's worth $530,000. I looked at it and I think the property is actually worth $500,000.
This seller wants their cake and to eat it too.
Right.
They want the highest purchase price and they want a massive down payment. So I always tell sellers when I'm negotiating with them, this is like a teeter-totter. You want a high purchase price? My down payment's got to be low. You want a high down payment? You got to give me a low purchase price. You can't have both sides down or both sides up. Otherwise the teeter-totter snaps. And so this person has a snap teeter-totter. It's snapped because of the tension. It's a win-win for the seller.
Right. The only piece of this that I'm seeing that I see some potential in that I wanted to ask you about is, the current interest rate situation that we're seeing. There's no 3.25 loans that exist right now, and they're not going to be coming around for a while. Is there no opportunity for an end? Because I know a lot of end users with $100,000 that would love to get into a house with $100,000 down and take over a 3.25% mortgage and be in this deal, right? This makes sense for an end user buyer all day long. Is there no opportunity for this pair to bring this to the market and try and sell this to an end user buyer?
All day long, all day long. So what's going on right now in the market is that people are getting homeowners are getting quoted at 6 and 7% interest, right? So in order for them to buy that house, they would have to be able to buy, they'd have to buy that house in the 350 range. This seller owes 430.
Right.
But you can afford a 430 or 530 house with a 20% down payment, because that's what they're asking for. They're asking for a 20% down payment.
Right.
As long as you are the end buyer, the person's living in the house. Because the only person that doesn't care about cash flow when buying a house is the person who is living in the home and building a family and memories and all of that. As a real estate investor, our value of buying a house is our cash flow, our return on the investment. As a homeowner, the value of buying a house is the return on our memories and return on the growth of our family and those types of things. That's where the value is of buying a house. They don't care whether the house cash flows or not. And a lot of people pay full retail value. Actually, most retail buyers pay full retail value for a house. A lot of them put 20% down on these homes, but none of them are getting 3.25% interest rates anytime soon, like you said. So I would say the smart thing for the two students to do, the Astro and Sub 2 student, would be to find an end buyer that maybe either A, just has a bunch of cash and has been priced out of the market because of interest rates, or B, even a buyer that says, I can't qualify for a loan because I am a 1099 employee.
I would really like this to be structured in the following way. If I could go and help them write this contract, I would do it this way. I would write it, and I would give the seller, and I would let the seller know that they're getting their cake and they're eating it too, and everything is tipped in their favor, and we are essentially making a really hard deal work. But this is how we have to do it. I would have verbiage in the contract that allowed me to list it on the MLS prior to close of escrow. And I would market it on the MLS to end buyers, and I would get it sold that way.
I love that. I love everything about that. And in our contracts that we give all of our students, it already has the ability to market the property on the MLS. So I love that. Really, really smart.
Incredible way to disposition that deal on the retail market and to attract that buyer who right now is just desperate for a 3.25% mortgage.
Love it.
What do you got on the table, bro?
Okay, I've got a deal from a girl named Ashley Perez. She's a BiggerPockets. In fact, the email she sent me says, BiggerPockets submission. Please look at my deal. Well, Ashley, we are going to look at your deal right now. The property is in Philadelphia, Pennsylvania. It is a condo, fully renovated, absolutely gorgeous. I'm looking at the photos right now. Wood floors, modern kitchen, gorgeous appliances, very, very nice. Literally everything has been either redone or is new from the way it was built. It's gorgeous. Good views, dual pane windows, awesome. Purchase price is $575,000, okay? Now, remember, in creative finance, purchase price is not the most important thing. It's usually down payment, interest rate, and length of term.
Right.
Now, out of that $575,000, the seller owes $271,000 to their bank, okay? And that interest rate is 2.75%.
Awesome.
Very low interest rate, 2.75%. Now, if their loan balance is only $271,000, now the seller is asking for, and they're saying, I'm okay seller financing $303,000 of my equity at 0% interest.
Okay.
Pretty awesome.
That sounds great.
So if you really look at it, effectively, the total interest rate on the total purchase price of $575,000 is under 2%.
When you blend that 0% and that, the other rate there, you're under 2. I mean, that's phenomenal.
Here's what we got. Okay. The seller wants $55,000 down. Okay, let me write this down. $55,000 down. I like that. I think if you can get into an interest rate right now at under 2% blended for less than 10%, that's about a 9% down payment. I like that. There's a couple of drawbacks to this, and I'll get into it for a second. The PITI and the seller finance portion combined are $2,500 a month.
Okay.
I can rent this property also for $2,500 per month. So there is no cash flow. Even after I put in the $55,000, there's actually no return on my investment if I bought this for a rental. However, this deal, looking at the deal right now, it looks like if I assign this to an end buyer, the ARV of this property is actually $600,000.
So more than what the purchase price is.
More than what the purchase price is.
Okay.
So what you could do in this situation, so she says here's the other drawback. The drawback to this is that it has a 10-year balloon, which means the seller is only going to seller finance this to you for 10 years. So in 10 years, you have to...
They want to be paid out that $303,000.
Right. So they want...
How about the other note? Will the other note stay, or do they want that paid out as well?
The other note will stay in place until it's all the way paid down.
Okay.
Okay, so they've got a 10-year balloon, which means that I have to refinance, get a new loan, and wipe out that seller finance portion. I got to sell the property, or I just got to just pay it down in cash, okay, which is not ideal. So 10-year balloon is not bad, but not 100% amazing. Here's what I would do. I actually think the exit strategy on this is the same thing as what Jamil suggested before. I think the smart thing for this person to do, Ashley, is to find an end buyer and sell it to them for $600,000. And instead of asking for $55,000, which is what your seller is asking for, I would ask for $75,000 or $80,000 down and give them a 2% blended rate. Make $20,000, $30,000, $40,000 on this creative finance deal. There's a buyer right now in 2 seconds that would take that deal in a heartbeat.
Yeah, Pace, I'm 100% in agreement with you there. I think this makes a lot of sense for an end user buyer. It has equity in it, which is great. It has a great interest rate, under 2%. It's unheard of right now. Somebody would jump at the opportunity to do that. And to get in at such a low down payment, I mean, think about that. Even if by paying you an assignment fee of $20,000, I mean, they're coming in far below 20% down, which, you know, for today's lending standards, it's pretty good.
I like both of these deals, but I'm trending towards the one in Pennsylvania because it has built-in equity for the buyer and a lower interest rate.
Yes.
The only thing I don't like about it is that it has a 10-year balloon on it. So as long as you can find a buyer that is okay with you selling them a product that has a 10-year expiration date on it, that they got to sell, move, whatever, then I think that that's probably a better way to go. I think you'd make about the same amount of money, but it's an easier product to sell on the back end, knowing that it has a little bit of equity into the deal.
Yeah, I'm in agreement with you there, Pace. I think between the two deals, I would also do the deal in Pennsylvania. I like that it's got a lower down payment. I mean, $100K down on the deal here in Arizona, I think that's just too high. You know, you've got a $55,000 down payment there, plus whatever the assignment fee is that the wholesaler, and you could negotiate that. But I'm in total agreement with you. Under 2% mortgage doesn't exist these days. And so I think that's a deal that'll fly off the shelf. You could list that on the MLS or find an end user buyer for it and get rid of it in a heartbeat.
Pretty amazing. Guys, if you've enjoyed this episode, please give us some love. Please make a comment. Please give us a review. And if you haven't already, by the way, BiggerPockets, I don't know if you saw this, just hit 1 million subscribers on YouTube. Yeah. I just noticed that this morning.
Congrats.
It's amazing. I think they are the only real estate specific YouTube channel that has actually hit 1 million subscribers. They have been and always will be on the cutting edge, which I'm super excited about, collaborating with BiggerPockets. And if you guys want more of these types of episodes, please give us some love in the comments, give us a like, share this with a friend. And by the way, submit some deals. We want to shout you out here on Buy This or Buy This, Not That on future episodes.
See you next time.